So first of all, very good morning to all of you. Good morning. Now, few rules before we start the live class. Let's make it as much interactive as possible. Okay, because that's the intent behind taking a face-to-face class. Because if you are making it interactive, that's what. Otherwise, you can watch the recording in YouTube also, right? That's the whole intent of taking. Now, another is, see, as you know that generally in CA final we should not prefer studying selective, right? That's what is said, and that's what I also suggest. But a day before the exam, we cannot revise each and everything. We cannot solve each and every questions. So we have to do smart work there. Now, when we have to do smart work, so how shall we study? Like, shall we skip some questions or shall we do everything? How exactly we should go ahead? So what I have done is, I have tried to summarize each and every concepts, and also I've tried to pick up the adjustments from your ICI material which are important but not the whole question. And also there are some questions which are very master questions which covers all the concepts or major of the concepts. I have taken those questions also, and I've drafted this material for you guys. Okay. Also, I've done the analysis for the past 10 attempts. If you can see in the screen, these are the chapters from which a question has been asked in all the attempts. And if you see, on an average, a question of around 63 marks has been asked from these chapters, these 5 chapters. And I'll say these chapters are revenue, leases, share-based payments, financial instruments, and business combination. Except for financial instruments and business combination, I'll say revenue, leases, and share-based payments. You will agree that if we can, if we sit and revise, we can revise in 2 hours or 2.5 hours per chapter, right? Now, if you go to financial instruments, you might take around 3 to 4 hours or 5 hours might be, and same for business combination as well. Now, spending around 12 hours, you can score 60 marks. So, a day before the exam, you have to do this analysis and then study, right? Because what a student does is, oh, FR, I have to give first 5 days for FR and then I'll go to SFM. No, don't do that. Never do that, because what will happen, might be your FR will go perfect in that case, but your SFM will get impacted. Okay, because your body will be habituated to study for one paper for 5 days, so your SFM might get impacted in that day. Okay, so give only 2 days at max or 2.5 days, not more than that. But yes, in that, do a proper planning of the things, how exactly we have to plan out the study. Now, when we are planning the study, just try to understand that these 5 chapters are important, but these are not the only chapters which you have to study. So give an emphasis to these chapters, but not the only chapters that you have to study. Okay. Now, if you can see, what I've done is, also I've done an analysis of all these 5 chapters from the attempts, past attempts, that which are the topics that have been asked. Now, if you see, coming to financial instruments, we think that's a very lengthy chapter, right? Now, just see the questions which have been asked. Majority of the times it has been asked financial off market terms, 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 right? Or a question has been asked on convertible loans, right? So like split accounting is done. So though the chapter is very vast, but the concepts which are being tested in the exam are very narrow, right? But yes, what you will see in the last 3 attempts, they are asking some new topics also, right? So definitely we cannot skip any topic in there for the exam, but yes, we can give emphasis to the topics which are being repeated in the exam. Okay, so that's how we have to do a proper planning of the things. Similarly, for the business combination also, if you can see, in every attempt they are asking for a consolidated balance sheet, or they are asking for calculation of goodwill or NCI. So that's a trend that is being set, and you'll accept the fact that in CA final also, around 60 to 70% of the paper is set directly from your book, and the rest 30% might be a new question, but the concept doesn't come new. All the concepts which you study are coming in the exam. Now, so that's an analysis of the past papers that I've done. Coming to the rules for this marathon session, first is interactive, that I've already said that let's make it as much interactive as possible, and that's what is the intent of this class. Okay. Queries, I'll give you time. So when I'm taking this class, might not be possible to take up queries, but yes, after every 1 hour or 2 hour, I'll give you time. Till then, you can note or down all your queries, and then we can discuss one by one all the queries. Okay, but yes, I'll ensure that I'll take up all the queries. Okay, not even a single query will be remain unattended. Attention, yes, that's what I will expect from you guys. Please pay 100% attention. That's what is the only requirement that I have. Okay, book See, for this concept capsule book, you do have an option that if you don't want to purchase, that's fine. If you want to purchase, you can contact the office. You can get the soft copy, you can get the hard copy also. Okay, that's what is the option available to you guys. Now, coming to the chapter of leases, we'll start with a very easy chapter on leases that is governed by Ind AS 116. I am assuming that you guys have already studied all the chapters at least once before, right? Anyone who have not studied any time before? Okay, very good. Now, guys, though this question will not get asked in the exam, but yes, I do want to ask you guys, what do you mean by the term leases? Anyone? Right of use asset. That's the only thing? No, right? See, understand. Okay, whenever we are doing business, right, we do need assets. Like if I'm teaching, I do need assets, right? This camera or this laptop or this whatever it is. Okay, so all the business in the world, they need assets. Might be now I have an option, I can purchase it or I can take it on lease. That's an option available to us, and that's what you decide in SFM, that option to take on lease or on purchase. But that's what we're not studying there. What we're studying here is if we have decided to take the asset on lease, what should be the accounting treatment for that? So before studying the accounting treatment, we need to understand what is a lease, right? So anyone tell me, what exactly do you think is lease, or how is it different from purchase? Okay, so basically you can say when we purchase, we get the overall ownership, but when we take on lease, we don't get the ownership, but we get the control for a particular period, and we'll not get it for free, we'll get it for a consideration, right? So what we are doing in a lease transaction, definitely there is a contract, whether we purchase or we take it on lease, there is a contract. There is a contract which gives us the right to use, right? Because I'm not becoming an owner, I'm getting the right to use that particular asset, okay? Or we can say it is an identified asset, okay? What is the meaning of an identified asset? Definitely we'll discuss in the class. So what is it? It's a contract that gives us the right to use of what? Of an identified asset. Now, if I've got the right to use of an identified asset, will I get for the whole life? No, for a specified period of life, which is called as lease term, right? Now, this lease term, when I'm getting the right to use, will I get it for free? No, I have to pay the consideration, which are called as lease payments, okay? Now, so that's the meaning of a lease. Lease is a contract which gives the right of use of an identified asset for a specified period of time and in exchange of consideration, right? Is that clear? Now, applicability, again, this will not get asked in the exam, but yes, for the sake of understanding, these are the particular assets of which lease will not be studying under Ind AS 116, okay, because they have a separate standard governed for them. Now, coming to the main concepts, lease date. Guys, understand, let's suppose what happens, I may enter into a contract today. To get the asset might be after 2 months. So will I start the accounting today or I will start the accounting after 2 months? I have entered into a lease contract today, but I will get the asset on lease after 2 months. So now tell me, in the earlier classes like CA Foundation we studied, we do the accounting of only monetary transactions, right? When I'm entering into any contract, is that a monetary transaction? No, that's not a monetary transaction, right? So I'll not do the accounting for that. So when I'll do the accounting, when I've got the asset, that's a monetary transaction, right? Because it is then the lease payments start accruing, okay? So there are two dates which is called as a lease inception date and lease commencement date. Lease inception date and lease commencement date. And lease inception date is a date when the contract is signed. And now tell me, will I do the accounting on this date? No. Lease commencement date is the date when the asset is made available to the lessee, and this is the date when I will do the accounting for the lease. Is that clear, everyone? Now, coming to the lease term. Understand, guys, when we discuss the lease term, we say a non-cancelable lease period. But let's understand why. Why do we say the lease term is a non-cancelable lease period? Okay, let's suppose I have taken this building for lease of 5 years, and I have an option to renew it. Or let's suppose in these 5 years, I cannot cancel this contract for the initial 3 years. After that, I can cancel the contract after giving 1 month notice. Now, how do we do the lease accounting? As if you know, we do the calculate the present value of the future lease payments, right? Now, what I did is I calculate the present value of the future lease payments for the for the cancelable part as well, if I did, and in the future I got to know that period I will not avail the lease itself. I will not be using that asset itself. So definitely I'll have to again remeasure the lease in the future, right? So standard says take that period in the lease for which you are certain, okay. Now that's the reason why we take non-cancelable term in the lease period. But now again the standard says, though you are taking non-cancelable, but if there is an option to renew the contract, though this is not certain, okay, but it says though if there is an option to renew and the lessee is reasonably certain that yes, I will exercise this period also, then you can include that part also in the lease term. Okay, I'll give an example for this, a very small example. Let's suppose I've taken this building on lease for classes, okay, for 3 years, let's suppose, and I've also started incurred expenditure on the installation of these devices, and I know that if I move to some other place, these devices I have to install it again, okay, and I will incur again further costs. And these devices have a life around, let's suppose, 6 or 7 years. So I know if I continue with this property, definitely I will be able to utilize these devices in a proper manner or an optimum manner, right? So it makes me reasonably certain, yes, I might definitely I'll continue with this property, right? So it is in that case I can say yes, I am reasonably certain. But again, understand that this reasonably certainty is an estimate that you are making, and the nature of estimate is it might change in the future, right? So you will also see in the coming discussions that we are discussing what if this reasonable certainty changes in the future, okay. Now same with termination period, though the non-cancelable period cannot be terminated, okay, but yes, it can be terminated with a penalty clause, right? That's the intent. So now it says if there is a termination option also available in the contract, we'll also consider that in arriving at the lease term, provided the lessee becomes reasonably certain here as well. So what it says is lease term is a non-cancelable period adjusted with the renewal option or termination option only if the lessee is reasonably certain. Is that clear, everyone, so far? Now exercise for you guys. Can you please try to read the question and solve it? The example. So what it says that ABC Limited enters into a contract with XYZ to use a grain storage facility like a sort of a warehouse, okay, for 5-year period in the months of May and June only. Now it says that I have entered the contract to take the warehouse for 5 years, but in these 5 years I will use the warehouse only for 2 months in a year. So now tell me, what is my lease period? 5 years or some other period? 5 years. So 10 months exactly. So though I have entered the contract for 5 years, but am I using for 5 years, right? I have got the control only for 10 months, and that's what is the answer, okay. So it will be 10 months. Is that clear, everyone? Very good. Lease accounting. Before I discuss the lease accounting in the books of Lessee, tell me one thing. Yeah, please. Yes, please. Okay, so now I totally agree. If that is from the point of view of lessor, we'll assess it different way, okay. But now we are assessing the lease term from the point of view of lessee, okay. So lessee and the lessor both will assess that lease term for themselves, okay. Now let's suppose I am a lessee, okay, and I will definitely assess the lease term from my angle, and the lessor will assess the lease term from his angle, because the party who terminates the contract has to bear the penalty. Is that clear? Okay, so that accordingly the lease term might differ for a lessee and for a lessor. And agree, but when the lease gets terminated, accordingly the penalty will be given and the lease liability and the ROU asset, and for the lessee the lease receivable will get netted off accordingly, okay. Now before discussing the lease accounting in the books of lessee, tell me guys, how do we do the accounting for purchase of an asset? If we are purchasing an asset, tell me, how do we do that? asset to bank. Let's suppose if I purchase asset on credit, asset to liability, right? Now I'm telling the accounting for lease is no different. The accounting for lease is exactly similar to what we do the accounting for the purchase. Okay, now tell me, let's suppose I have purchased an asset on EMI model or EAI model, equal annual installments. How will I do the accounting? Tell me. I will definitely calculate the present value of all the future payments, right? I will calculate the future present value, and then I'll record the asset and I'll record a liability, and this liability I will unwind every year and record. Clear? So same way we do the accounting for lease as well in the books of lessee, because see, as I told, a lessee has two options, purchase or lease. The accounting for which doesn't matter materially, but yes, what we do is when we purchase, we get the ownership of the asset, but when we lease, we don't get the ownership, but rather we get the right to use that asset, and that's the reason why we record a right to use asset here and a lease liability, because this liability is coming from a lease contract. Is that clear, everyone? Okay. Subsequent treatment we'll discuss definitely, but let's come further. Now, definitely we understood that the accounting treatment, the initial accounting treatment for a lease is the right of use asset account debit to lease liability. But the question that comes up now is how will we measure the right of use asset and how will we measure the lease liability, right? Now, coming to this part. The lease liability. As all of us know, the lease liability is the present value of the future lease payments, right? Now, two questions comes up here. When we have to calculate the present value, what discount rate we have to use? And again, what is the meaning of future lease payments? Clear? Now, discount rate. If you go to the standard says this is what you have to use. Interest rate implicit in the lease or incremental borrowing rate of the lessee. Now, what is the meaning of interest rate implicit in the lease? Now, think from the point of view of lessor. The lessor would have purchased the asset, would have given on rental to lessee, and from which he will earn the rental income, right? So definitely there will be a rate of return for the lessor, right? And this rate of return is called as interest rate implicit in this lease transaction. Okay, but now tell me, practically, will lessor try to disclose this rate to the lessee? No, right? Because definitely the supplier will not disclose the profit margin to the customer. They will not disclose, right? So that's the reason why practically we prefer taking incremental borrowing rate of lessee. Okay, because the lessee will definitely know the incremental borrowing rate that is available for him. Okay, but in the standard says this is priority 1 and this is priority 2, but in practical life we take this one, we take this one, okay, and not this one, because that is not available with us only. Okay, now see, that's the answer to the first question. Now coming to the second question, future lease payments. How will I calculate the future lease payments? Now tell me guys, first question, before I explain the meaning of future lease payments, on what date are you calculating the future lease payments? Lease commencement date. Okay, now let's suppose I have taken a asset on lease for 3 years. Okay, this is the lease commencement date. Okay, so basically I am estimating the future lease payments as on this date, right? Now definitely tell me, if there is some variable lease payments to be paid on this date, to be paid on this date, to be paid on this date, will I be able to estimate here? Standing on the lease commencement date, will I be able to calculate the variable lease payments that I'll pay in the future? No, right? So the only logic behind calculating the future lease payments is consider those lease payments as part of the lease liability. Consider those lease payments as part of the lease liability, which you can calculate on the lease commencement date. If there is any lease payment which you think you cannot calculate on the lease commencement date, do not consider that in the calculation of lease liability. Okay, we'll definitely see the examples for that. Don't worry. Future lease payments. So what I do is we divide the future lease payments into two parts. One is fixed and another is variable. Fixed and variable. Now fixed can also be divided into two parts. One is pure fixed, like I can take an example of rupees 1 lakh per month. It's pure fixed, there is no variable component involved. So definitely I'll take this as part of my lease liability. There is no challenge in that, because definitely if I'm saying I have to pay 1 lakh per month for 3-year period, definitely I can calculate that. Okay. Now there is some, if in the fixed portion of lease payments I include a variable component as well, then how will I do that? Let's suppose the example is here. The lease payments are 1 lakh per annum or 3% of the cash flow from the asset, whichever is higher. Now tell me, can I calculate 3% of the cash inflow from the asset for the future 3 years? Can I calculate? Definitely I will not be able to calculate. If you can talk about estimate, yes, we can estimate, but that too not with virtual certainty. We can estimate with an assumption or a judgment on the basis of past practices, but we cannot estimate with a certainty. So what happens? Definitely I have to pay 1 lakh per annum in all the cases, because let's suppose 3% of the cash flow which I'm getting is less than 1 lakh, then definitely I'll pay 1 lakh. If 3% of the cash flow is more than 1 lakh, then I'll pay that amount, let's suppose 1 lakh 10,000 or 1 lakh 20,000. So in all the cases I am paying 1 lakh in every cases, right? So what happens in this case, though this agreement seems to be variable, but still 1 lakh is in substance fixed and the rest is variable. Clear? Okay. Now I'm not explaining what is the treatment of variable now. I'll explain going forward. Okay. But first let me explain the classification which I will consider in the lease liability and which I will not. Okay. So this I will be considering in my lease liability. Now pure variable. If the lease payments are purely variable, so definitely I'll not be able to calculate as on the lease commencement date, right? So definitely I'll not be considering this in the lease liability calculation. Clear everyone? Now variable linked to index or a lease payment, okay, linked to index or a rate basically. Now let's suppose what I've done is I've taken a property on lease for 10 years and I have decided the lease rental will be 1 lakh per annum. So do you think the lease rental will remain constant for the 10 years? No, right? Because the inflation will be there, the prices will increase, right? The purchasing power parity will decrease. So what will happen is I have to increase the rental going forward. So it can increase in two manners. One, I'll say that the lease rentals will increase at a fixed rate every year, 10% or 15% or might be 20%. Or I can say the lease rentals will increase in line with the index or in line with the inflation. Now, if I say that the lease rentals will increase at a fixed rate, we are certain, okay, this is how we have to, this is the lease payments for the next 10 years, okay, which is purely fixed, no challenge in that. But what if it will increase with the index? Can I calculate as on today? Do I know what will be the index for the future? I don't know, right? So what I'll do is I'll consider what is the index today, and according to that what is the lease payments, okay, that I have to pay for the next 10 years. I'll consider that and consider in my lease liability. Okay, but if there is a change in the index in the future, we will see that we'll do the lease remeasurement. Okay. Now comes the residual value, guaranteed or unguaranteed. What happens? Let's suppose I give this pencil to you for using. Okay. Now what happens? I know that you will use it in a very you can say, though we have to use this pencil for 2 hours a day. Okay. And I know that you will use this pencil for around 8 to 10 hours a day. Okay. Then I'll say that you will use this asset in this manner that the life of this asset will decrease. So then the lessee says, okay, I'm guaranteeing a portion of the residual value which you will get. Okay. So that portion which the lessee guarantees to the lessor is called as guaranteed residual value, and it forms a part of lease payments. Okay. And since this amount is fixed, it will we will call it as a part of the lease liability. Is that clear, everyone? But now, unguaranteed residual value, will it form part of lease payments? Unguaranteed, no, it will not form part. Now, let's suppose I've taken an asset on lease for 3 years, and the lessor has also included a term in the contract that there is a purchase option, that if I want to purchase at the end of the lease term, I can purchase it off also, and the purchase price is also given. So now if I purchase that asset at the end of the lease term, definitely I have to pay the purchase price to the lessor. So standard says that if the lessee is reasonably certain to purchase the asset at the end of the lease term, then include this purchase price also in the lease liability. Okay. So basically, see, the whole intent is two things: the amounts which you can calculate on the lease commencement date, and the amounts which the lessee has to pay to the lessor. If these two conditions get satisfied, we have to include all the amounts for future lease payments, which we'll use for calculating lease liability. Is that clear, everyone? Now, penalties, if any, right? So if, let's suppose I am terminating the contract, definitely I have to pay the penalty, right? So that penalty will also form part of my lease liability. Okay, but yes, understand one point here, logical point. When I'm entering into that contract on the lease commencement date, definitely this penalty will not exist. Why? Because I'm entering into lease commencement date, I'm getting the asset now. I will definitely not be reasonably certain to terminate the contract after 2 months, right? Going forward, let's suppose the lease term is 5 years. After 2 years, I might think of, oh, I have to terminate the contract, right? Then if I terminate the contract, I have to pay a penalty. So in that case, I have to factor in the penalty there. Is that clear, everyone? Okay. So very rarely you might find a penalty on lease commencement date itself. Okay. That's the point which has to be included in the future lease payments. So if I have to summarize it: fixed lease payments, in substance fixed lease payments, then variable lease payments linked to index or a rate, then comes a purchase price if the purchase option is reasonably certain, then comes guaranteed residual value, and then comes penalties. 6 points. Is that clear, everyone? Okay. So while calculating lease liability, as we discussed, two questions to be answered: what discount rate, and what are the meaning of future lease payments. And I believe I have discussed both of the things. Is that clear, everyone? Good. Now, can we take up the queries? Like after every 1 or 2 hours, I'll give you the time to ask the queries. Till then, you can please note down all the queries. I'll take up all the queries. Okay. Now till when we purchase any asset, as I told, that we record at its cost. Okay. Now the cost means what? The amount which we have already paid, or the amount which you have to pay in the future. And if it is amount that has to be paid in the future, we calculate the present value of it, right? So now ROU asset is no different. So ROU asset also needs to be recognized at cost. And what is the cost? Amount already paid plus the amount to be paid. What is the meaning of amount already paid? If you can recall the concept of upfront payments, the lease payments which has to be paid at the start of the year, right? So in that case, the upfront lease payments becomes the amount already paid, right? Because that will not form part of lease liability, but that will definitely form part of the lease ROU asset, the lease asset. Okay. If you have incurred any initial direct costs, if you can recall Ind AS 16, what we at what value did we recognize the asset? Purchase price plus any directly attributable costs incurred to bring the asset in the location or condition intended by the management, right? So there also we capitalize the initial direct costs. Similarly, we are doing it here as well. So understand that ROU asset works totally in line with Ind AS 16 or Ind AS 38 or Ind AS 40, okay, as the case may be. Now, amount to be paid means amount that has to be paid in the future, which includes your lease liability that has to be paid in the future, okay, or provision for decommissioning costs. Now again, link it with Ind AS 16. What we used to do there, in Ind AS 16, we used to capitalize the provision for decommissioning costs with the asset. Is that clear, everyone? Just to going off the track, what is the meaning of provision for decommissioning costs? Anyone? Pardon? Basically, the cost that will incur at the time of end of the useful life on decommissioning or restoration of the place, right? All those things. Very good. So we calculate the present value of that. Okay. So that is also an amount that is to be paid in the future. Now, so initially I told here the journal entry at the time of initial treatment is ROU to lease liability. Now let's revise the journal entry. The revised journal entry becomes ROU asset account debit to lease liability, that is the amount to be paid, to bank, amount which I have already paid plus the initial direct costs, to provision for decommissioning liability. Is the initial treatment for a lease transaction. Is that clear, everyone? And I'm not taking any question on this one because a question on that will be very basic. Okay. Now, coming to subsequent treatment, lessee's books. Subsequent treatment, as you know that lease liability is like a finance liability, right? That is governed under Ind AS 109. Because what happens, what is the meaning of lease liability? It's a contractual obligation. Can I avoid it? No, I cannot avoid it. That will be delivered by paying of cash or any other financial asset. So it becomes what? It's a sort of a financial liability. And how do we record a financial liability? Amortized cost method. And now what is the meaning of amortized cost method? We'll unwind it, we record finance costs and we pay the contractual payments, right? So that's how we'll record a lease liability. Now, so similar, it says that lease liability will be amortized as per Ind AS 109. That is opening lease liability plus will calculate finance costs minus will reduce with the actual payments, and the journal entry will be like this: finance cost account debit to financial liability, and lease liability account debit to bank. This is for the payments and this is for the finance costs. Clear, everyone? Okay. Now, right of use asset. Again, as I told that right of use asset works in the similar line as with Ind AS 16 or 40. Now, what happens in Ind AS 16 or 40? When we follow cost model, we depreciate it, right? Now, understand what is the meaning of depreciation? Depreciation means over the useful life. Now, what is the useful life for a right of use asset? What is the useful life for a right of use asset? The lease term. Because what is the meaning of useful life? The life over which we can use the asset. For a right of use asset, we can use the asset only for the lease term, right? So the lease term becomes the useful life. So it says that we have to depreciate it over the lease term. But now understand, if there is a purchase option in the lease contract, if there is a purchase option in the lease contract, tell me, in the lease liability, did I include the purchase price? Right, I include the purchase price. Now, so the lease liability or the ROU asset which is recorded includes the price not only for the lease but also includes the price for the purchase. So the useful life for me is not the only lease term, but it's the remaining lease useful life. Okay, remaining useful life of the asset, not from the point of view of lease, but rather from the point of view of the asset. Clear, everyone? Okay, so it says if there is a purchase option and the lessee is reasonably certain, then you have to depreciate over remaining useful life. Is that clear, everyone? Good. Now, while measuring the lease liability, definitely we have used certain estimates. Let's name few of them. First estimate that we have used is, you can say, guaranteed residual value. Because see, though I have guaranteed a particular amount to the lessor, but I don't know what is the exact residual value at the end of the useful life. So that's one of the estimate. Another estimate is consumer price index. The inflation rate is also an index. The third estimate is the reasonable certainty of exercising any option, whether it is a purchase option, whether it is a renewal option or an extension option, or whether it is a termination option for that matter, right? So definitely we have used these estimates, and now you will accept the fact that it's the nature of estimate that it will change, right? It will change. Definitely we would have made plans for going Goa with our friends, and we have estimated that, okay, this is the amount that we will incur. That's an estimate, right? And it will change. So estimate is bound to change. Now, comes the question, what if estimate changes? How will I do the accounting treatment for that? And that's what is coming in lease remeasurement. Understand, student makes a mistake here. They think lease remeasurement and lease modification is same. No, there is a difference. Lease remeasurement means there is no change in the terms and conditions of the lease contract. There is a change in the estimates from your side. Okay, your thought process have changed. Lease modification on the other hand means there is no change from your side, but rather there is a change in the contract itself. Okay, so that's the difference between lease remeasurement and lease modification. Is that clear, the difference between them? Okay, now understand. Lease remeasurement means any change in the estimates made at the commencement of the contract. Means whatever estimates we have made at the time of commencement of the contract, if the estimates changes subsequently, how will I do the accounting for that? Okay, now understand the change of estimates also that happens. The estimates can be minor, estimates can be major. Like if I have to say estimate like index is not something very major. Estimates like change in the guaranteed residual value is not something very major. But estimates like reasonable certainty of exercising any option is something very, it's something like which changes the substance of the contract itself. Let's suppose extension option. I have taken the contract for 5 years, but I have an option to extend for further 5 years, right? Initially, I thought, no, I will not exercise this extension option. But at the end of 3rd year, now I feel that yes, I have to exercise this extension option as well. Now, what will happen? The overall substance of the lease contract itself changes, right? Now, if I have to take termination option, in termination option, initially I thought definitely I will not exercise the termination option, but let's suppose COVID hit the market and now I want to terminate the contract. So now again, that's a substantial change in the contract, right? So now its standard says that whenever there is a change in estimates, like change in the guaranteed residual value or change in the index, which I definitely thought will change in the future, okay, we will use original discount rate for the lease remeasurement. We'll use original discount rate. But when the substance of the contract itself changes in the future, okay, in that case we will use the revised discount rate. In that case, we'll use the revised discount rate. But now comes the question, what is the use of the rate now? What is the use of the rate? How will I do the lease remeasurement? Definitely we would have understood that, okay, if the estimates are changing, which estimate is minor or which estimate is major, in change of which estimates we'll use which discount rates. We have understood it. But the question that comes and the which will ask in the exam is, how will I do the accounting for lease remeasurement? I'll say the accounting for lease remeasurement and lease modification, the thought process remains the same. Okay, the accounting for whether it's a lease remeasurement or the modification, the thought process remains the same. So what you have to do is, first you have to find what is the value of the lease liability and the ROU asset on the date of lease remeasurement. What is my value as of now, the carrying amount of it, okay? Then what is the revised value of lease liability? See, understand, when you do the accounting for lease, the right of use set gets governed by the lease liability. It's not with the other way around, right? So when we do the lease remeasurement, we remeasure the lease liability, not the ROU asset, okay? So first we have to remeasure the lease liability. Now, how we have measured the lease liability initially? The present value of the future lease payments, right? Now, when we have to remeasure the lease liability, now what I will do is, I will first calculate the carrying amount. Then when the estimates have changed, definitely it might lead to change in the lease payments also, right? So what I do, I will consider the revised lease payments. But I will take the original discount rate, okay, or you can say original or revised as per the situation, okay. Now, considering these lease discount rates, I will calculate the revised lease liability. Then what I'll do is I'll compare the original lease liability with the revised lease liability and see what is the change. And then when I'll calculate, okay, this is the change in the lease liability, I'll make a corresponding change to the ROU asset. Now, what is the meaning of corresponding change? Means if lease liability is increased, I will increase the ROU. If lease liability is decreased, I will decrease the ROU. If lease liability is increased by X amount, I will increase the ROU also by X amount. Means there will be no impact in the P&L. Understand, whenever you are doing the lease remeasurement or the lease modification, there will be no impact in the P&L except for one situation, which is called as decrease in scope in the lease modification. Okay, so in the case of lease remeasurement, never give an impact to P&L. Okay, and that's a mistake which a student does in the exam, which you have to avoid. Okay, please make yourself comfortable with these steps, and then we'll try to solve a question. So what is the steps? The steps are: first, calculate the carrying amount on the date of lease remeasurement. First, calculate the carrying amount. Then second is calculate the revised lease liability. Now, how will we calculate the revised lease liability? Using the revised lease payments and the applicable discount rate, that is either old discount rate or revised discount rate. Clear? Now, then make a change in the lease liability. Calculate the change in the lease liability, that is step 2 minus step 1, that is revised lease liability minus the original lease liability. Clear? Then make a corresponding change to ROE asset. Now see this journal entry. Is there any impact in the P&L? So I'll write here no impact on P&L. So in case of lease remeasurement, do not give any impact on the P&L. Okay. This question you just ignore for the time being. I'll come to this question again. But now, just okay. Is lease remeasurement clear, everyone? What I'll do is first I'll take up lease modification, then I'll take up two questions on one on the lease remeasurement and one on the lease modification. Okay. And I believe you would have understood also which question I'm going to take. Good. Now coming to lease modification. So in the lease modification, there's a change in the terms and conditions. Now, what I exactly said few minutes back, lease remeasurement means change in the estimate from my side. Lease modification means change in the terms and conditions on the contract. So the contract is changing, not the estimates. Okay. Now when the contract changes, it can change from multiple aspects. One is either the scope can increase, scope can decrease. Lease payments can increase, lease payments can decrease, lease term can increase, lease term can decrease, right? Now there are six possible modifications. But now what I've done is I've tried to summarize that in three parts. First is increase in scope. Increase in scope means when let's suppose I have taken one floor on rent. Okay, initially for 5 years. After 2 years, I thought that okay, I need one more floor. Then I included one more floor in that contract itself. That's called an increase in the scope. Now you will definitely agree, when the scope increases, definitely the lease payment will also increase. Now understand this fact that when the scope increases, the lease payment increases. But there can be two things. Let's suppose I'm already using this floor. Now I want to take one additional floor. Now I know the rent for that additional floor is 1 lakh per month. But definitely when I'll go to the lessor to negotiate, I'll say, see boss, I'm already using this floor. Please give me some discount, right? So he might say, okay sir, since you're already using this floor, I will give you at 80,000. So now due to this pre-existing relationship, I am getting a discount in the new relationship, right? So what is happening? The price for the additional or the increased scope is not the market rent, right? Because if I would have taken a property in the market, I would have got how much? At 1 lakh, right? But now here I am getting at how much? 80,000 only, right? So this is what it says. Now, but standard says that if the scope increases, and the lease rental also increases, and this increase in the lease rent is in line with the market rental, then treat that as a separate contract. Okay, basically what I'm trying to say, if I've taken an additional floor and the rent of that floor represents the market rent, I have to treat that floor as a separate contract. I have to treat that floor as a separate contract. But if that rent is not in line with the market rent, then it will be part of this contract itself and will treat as a lease modification, and the accounting for which will be covered here. Okay. If it is commensurate, it will, yes, I'll write here, and if no, I'll come here. Is that clear, everyone? Now, second case is decrease in scope, which I will cover up, not now, just give me some time, then I'll cover up. Okay. The third case is all others. Now, in all others, what all will be included? See here. Increase in scope with increased lease payments. The lease payments are not commensurate with the increased scope. Okay, that is, the increased lease payments are not in line with the market rentals. Okay. Second, increase in the lease term, or third, any change in the lease payments, whether increase or decrease, without corresponding change in the scope. Meaning thereby, let's suppose I took a property, this property on lease for 5 years, which a rental of 1 lakh per month. Okay. Now, after 3 years, the lessor come to me and said, Vishal sir, though we initially contracted at a rental of 1 lakh per month, okay, and there is no clause of escalation in the contract, but still I want to increase the lease rentals. Okay, if you can do so, fine, otherwise you can vacate the property. Okay. Now what I do, I don't have any other option, so what I'll do is I'll increase the lease payments. That's also a modification, because that's a change in the terms and conditions of the contract, which was not there in the original contract. This is also a lease modification. Okay, because the scope is not changing, I'm still using the same floor. Okay, but the lease payment increases. Is that clear, everyone? Now comes the accounting. And as I have said, the thought process behind the lease modification and the lease remeasurement remains the same. But case 1, that is increase in scope, if I will treat it as a separate contract, meaning thereby I will again apply the same initial accounting treatment, the subsequent accounting treatment, right? Basically, think it is a separate contract itself. So I believe that I don't need to discuss the accounting treatment for this one. Case 1, clear? Case 2, I have not explained. Coming to case 3. Case 3, again, what you will do? All others. What you will do is, first you will calculate what is the carrying amount of the lease liability and the ROU asset. Then you will calculate the revised lease liability. But one thing will change here. In the lease remeasurement, you have to select the original discount rate or the revised discount rate. But here, in every case, it will be revised discount rate only. Clear? It will be revised discount rate only. Now, okay. So now the accounting will be, first you have to calculate the carrying amount, then you have to calculate the revised lease liability. The third will be, you have to calculate the change in lease liability. Now, once you have calculated the change in lease liability, what will be the fourth step? Tell me. Exactly, make a corresponding change to ROU asset. Okay, will there be any impact on the P&L? No impact on the P&L, because see what I've written here, exactly same as lease remeasurement. Okay, so all other cases, just remember it's exactly the same as lease remeasurement. Only change is you have to calculate revised discount rate. Case A is increase in scope with commensurate, means you have to treat as a new contract itself. So what you have to study is only one thing in lease modification, that is decrease in scope. So the lease modification, which we used to feel is a very difficult concept, now you have to study only one thing, decrease in scope. Clear, everyone? Now, I am not taking the decrease in scope as of now. First, I will take up a question now. This is the question which is taken directly from your ICI material. Let's try to solve this question. So do you want to solve it yourself, or you want me to solve it? I think I'm giving you 5 minutes to read the question, understand, and then we'll try to solve it together. Okay? 5 minutes. Time now is 10:53. 10:58, we'll start discussing the question. Question on lease remeasurement or modification? And what are the estimates which are changing? Pardon? There are two estimates which are changing in this question. Borrowing rate, I agree, but borrowing rate we take when there is a lease remeasurement or a modification, right? So that's not an estimate we can say. But what are the two actual estimates which are changing, due to which we have to consider the revised discount rate or the original discount rate? CPI, very good, and renewal option, very good. So two options or the two estimates which are changing in this question are. Please try to solve this question also. One is the CPI and another is the renewal option. But now tell me, when there is a change in CPI, which discount rate do we use? Original. And when there is a change in renewal option, which discount rate do we use? Revised. Now, what will you do in this case? So, shall I for CPI, shall I calculate at original, and for renewal, shall I calculate at revised? No, right? So, now tell me, both are a change in the estimates only, right? Renewal option changes the contract substantially, right? Now, so it is because of that reason, what we will do is we will take revised discount rate, and that's what I wrote it here. Come here, just a minute. Read this line now, this point. When there is a change in the amount of lease payment due to index, that is CPI changes, along with the reasonable certainty of availing any option, which rate to be used? Because see, this will require revised, this will require original. So in that case, we have to use revised discount rate. This is the only crux that is required in the question. Rest all I think you can solve. See, calculating the present value, taking the impact, definitely everyone can do. A student will make mistake at this point. Okay, he will get confused whether I have to take a revised discount rate or the original discount rate. Okay, so that's the only thing. Now, can you please solve it fastly? Whatever points I have highlighted in brown, that's a point which you have to revise on the day of the exam. Your exam starts from 2 p.m., right? You study in the morning, right? So all the brown highlighted points you have to read on that very morning. That's the crux of all the important mistakes that a student does in the exam. What is the journal entry on lease commencement date? Calculate. Can you even tell me the amounts? The lease is for 5 years initially, right? Now, for 5 years, we are paying in advance, right? What is the discount rate initially? 5% is the discount rate initially. So now, on this lease commencement date, definitely I'll pay how much? 1 lakh. Now, for these payments, I have to calculate what? Present value. Can you please tell me what is the present value? 354,595, right? I might be wrong in the calculation, so please keep on changing the calculation which I'm doing. Is the general entry correct? Now, what does it say? So this is this paragraph I believe is clear. Now it says further, CPI changes on 1st January 20x4 means this one was 20x1, x2, x3, x4. Here the CPI changes. Now, when the CPI changes, so can you please tell me on 1 January x4 what is the carrying amount of lease liability and ROU asset? Can you please do that? ROU asset, let me calculate. 454, 3 years. What is the carrying amount of lease liability? Pardon? 90,900. I don't think so. I think it should be much more. See, it's okay. Let's calculate. Here it is how much? 354,595. Now 354,595 into 1.05. Okay, this becomes 372,324. Right, minus 100,000 into 0.105. Okay, so it's 285,940. Again minus 100,000 into 1.05. It's 195,238. 195,238. So it becomes 195,238. Now, what change happens? So it says the CPI changes from 120 to 125. Now what happens on 1st January 20x4, 1st January x4, here we have to pay 1 lakh, and again on next I have to pay 1 lakh, right? CPI changes. Further, it says that at the lease commencement date, entity W did not have a significant economic incentive to exercise the renewal option, means it was not reasonably certain. In the first quarter of 20x4, that is on the same date, on this date, entity W installed a unique lease improvement into the retail store with an established estimated 5-year economic life. Entity W determined that it would only recover the cost of the improvement if it exercises the renewal option. Okay, so means it becomes reasonably certain to exercise the renewal option now. So what we'll do is we'll take that also, 1.1 lakhs, 1.1 and 1.1 is will also go here. Okay, now so this is the original lease payments, but the index have changed now, right? So we'll revise the lease payments according to the change in the index. So what I'll do is multiply by all these lease payments. I will do multiplied by 125 divided by 120. Clear, everyone? Now what will be the lease payments? Year 1, 2, 3, 4, 5, right? 1, 2, 3, 4, 5 payments, right? Now 100,000 into 125 divided by 120 is 104167. 104167. Now here it is 110,000, into 125 divided by 120. That comes to 114583. Same thing and same thing. Right, now tell me, we will use discount rate revised. So what is the revised discount rate? 6%. Wonderful. Can you please calculate the present value? These are the future lease payments, revised future lease payments at the revised discount rate. So what is the revised lease liability? Come on fast. $463,569. Okay. Now this is the revised lease liability. Now what was the original lease liability? 195,238. So can you please tell me what is the change in lease liability? Change in lease liability is how much? 463,569 minus 181,838. 181,838 is how much? 281,731. Okay. Now what is the journal entry? The journal entry will be ROU. See, your lease liability is it's 190. Okay, 195. Sorry, I'm sorry. It's 195 to date. Thank you. 195 238. Okay, just 260 831. Correct now? Okay. 268 831. Correct now? Now tell me, the lease liability is what? Increased. So what we'll do? ROU also will increase. So it will be ROU asset account debit to lease liability, and the amount will be 268,331. This is the accounting treatment for a lease remeasurement. Is that clear, everyone? Now, so what will happen now? Just a quick summary of it. Your lease liability, the carrying amount of the lease liability and the ROU was how much? 195,238. It will increase with 268,331. Now ROU was 181,838. It will increase with 268,331. Right? So it will become how much? 463,569. And this will become how much? 181. Pardon? 169. Now what will we do? This we will amortize over the next 5 years, and this will amortize over the next 4 years. I believe you have understood why 4 years, because it was at the beginning of the year. Clear, everyone? This is the accounting treatment for a lease remeasurement. Okay. Now we can take up the queries till here. Except for decrease in scope, I can take up the queries. Come on, guys. Right. Right. In this case, we are using principal account. Right. Which means when the company is following WDP, so in that account,
we are considering a purchase option.
Right.
In future,
Mhm.
so that asset will be owned by us.
Right.
If we are following as a company policy, overall accounting policy,
Mhm. Mhm.
so will this principle have a small impact?
See, definitely it will have an impact. I'll not deny the fact that it will not have an impact. It will have an impact. But yes, understand. See, purchase option is a option, right? Might be the case that when I've taken the asset on lease, I might not have that option at that point of time. Okay. But what happens is subsequently when I exercise this option, or subsequently when I become a reasonable certain to exercise this option, okay, it is then I will include that purchase price in my lease liability and in my ROU asset and subsequently depreciate it off. If I would have included this purchase price at that point of time, right, the depreciation would have been higher at that point of time itself, right? But now the depreciation will get impacted. It will definitely have an impact, but yes, that's an option which I was not certain at that point of time, and which if it becomes certain now, it will change the depreciation amount accordingly. Okay. Any other queries, anyone? Come on, guys. Mhm.
Based on economic life, in case the ROE is
Pardon, I didn't get your question. Mhm. Mhm. Okay. See now, asset might have an economic life. Definitely agree. But what we do, we depreciate over useful life, right? And in the case of a lease transaction, the useful life is the lease term and not the economic life. Agree? Because see, the economic life might be different from the lease term. Might be different. Okay. But understand, what if I've taken an asset on lease? Okay, I've taken an asset on lease, and the lease term is 5 years. The economic life is 8 years. Will I get the asset to use for 8 years? No, I will anyways use the asset for 5 years only. Okay, but to take your question in different manner, if the economic life is 3 years only, and I've taken an asset on for 5 years, okay, in that case I will depreciate over 3 years. But that case is not practically possible, because if you see the economic life is 3 years, then why will you take the asset for 5 years? Right? Practically not possible in that case. That's why we say that in general situations, what we do is we depreciate over lease term. Clear? Do you need break or we can continue? Okay. Let's check up the decrease in scope now. Now understand what happens when we decrease the scope. We are de-recognizing a particular asset, okay? And whenever we de-recognize any asset, or let's suppose I have this building, I own this building, and I have 10 floors in the building, okay, and I sell 2 floors of a building. Definitely I will recognize a gain or loss on the sale of that building, right? So it will have an impact in the P&L. Now what I'll do, similarly in the lease transaction also, if the scope gets decreased, okay, means I am you can say I am leaving off certain rights which I already had for certain payment, okay, I will have to take an impact to the P&L. Now comes the question, how exactly I have to account for the decrease in scope, and how exactly I have to account for the P&L impact. Now generally what I've said is whenever there is a lease modification, I have to take the revised discount rate. But now when I have to account for a decrease in scope, means the asset which I have already recognized, I have to de-recognize that portion of it, right? So what I will do is, first of all, the concept remains the same. I will calculate the carrying amount of the lease liability and the ROU asset on the date of lease modification. Then I have to calculate what would have been the lease liability. Listen to my words particularly here. What would have been the lease liability if the scope was decreased? Meaning thereby, if the scope decreases, at the same term, same estimates, same everything same, just the scope decreases, what would have been my lease payments and what would have been my lease liability, right? So what I will do, I will revise the lease liability with the revised lease payments, but I will consider the original discount rate. Why? See, when you have something and you want to add something, you can take at the new terms. But when you have something, you have to de-recognize the portion, you will de-recognize at the old terms, right? So when you are de-recognizing it, you will de-recognize at the old terms, okay? So what you will do is you calculate the revised lease liability using the old discount rate, okay? So that's what is written here, see. Remeasure lease liability for revised lease payments at original discount rate first, then reduce ROU asset proportionately. Let's suppose you had two floors you have taken on lease. Now you have reduced to one floor only. So your asset has decreased by 50%. So you will decrease ROU also by 50%. Okay, decrease ROU also by 50%. Now, so what will happen? Your lease liability will decrease, your ROU will also decrease, but both of them are decreasing by different amounts. Are you agreeing with me? Because what will happen? See, you have a carrying amount of lease liability, you have a carrying amount of ROU asset. Lease liability, what you do, you calculate the revised lease liability and calculate the decrease in lease liability. Okay, you decrease the ROU asset proportionately. So far what we did is whatever is the decrease in lease liability, make a corresponding change to ROU, but we are not doing it this way. In this case, decrease in scope, we are decreasing lease liability separately, we are decreasing ROU asset separately. Now when both of them will decrease by different amounts, there will be a balancing figure. This balancing figure is the impact in the P&L. Okay, this balancing, because see, when you decrease your asset, means your asset gets de-recognized. When your liability gets reduced, okay, that's the consideration that you are receiving for decrease in the ROU asset. Okay, so there will be difference, and this is the impact in the P&L, that is gain or loss on the decrease in scope. Now, record the reduction in lease liability and the ROU asset, and any difference is transferred to SPL. The lease liability account debit, ROU asset account credit, and the balance will be transferred to P&L. But now understand, whenever there is a decrease in scope, okay, definitely something substantial have changed in the contract, and since it's a lease modification, we have to bring the lease liability at revised discount rate, right? Now again I will apply the concept of lease remeasurement at revised discount rate. So what I do, I will again remeasure the lease liability at revised discount rate. Now again I will not do ROU asset differentially, I will make a corresponding change to ROU asset. Okay, so now what I'll do is lease liability change this much, and I'll make a corresponding change to ROU. So now here again you will see there is no impact to P&L. Only difference in decrease in scope is, since the scope is decreasing, you are de-recognizing an asset. When you de-recognize an asset, you have to take the impact to P&L. When you de-recognize the asset, you de-recognize what was actually recognized earlier. So that's the reason why you de-recognize at original discount rate. Okay, but at the end it gets recognized at revised discount rate only. Is that clear, everyone? Sure, no worries. First and foremost point, understand, whenever there is a decrease in scope, okay, you are de-recognizing something. You can de-recognize only those things which you have recognized earlier, right? So whenever we are de-recognizing, we have to de-recognize at earlier terms. Okay, so that's the reason why we remeasure the lease liability at original discount rate, because that was the rate which we used to recognize, and that's the rate which we used to de-recognize as well. Okay, now ROU asset will de-recognize proportionately. So lease liability decreases, ROU asset decreases, right? So, but both of them are decreasing separately. There will be balancing figure. This balancing figure is the impact to P&L. Clear, everyone? Now, since it's a lease modification, definitely I have to bring the lease liability and the ROU asset at current terms. Okay, so I will again measure the revised lease payments, revised lease liability, but this time using the revised discount rate. So now lease liability will either increase or decrease depending upon the discount rate. Now I will make a corresponding change to ROU like the way we used to do in lease remeasurement. Clear now? Okay, so now in the last point we are passing an entry lease liability account debit to ROU asset, or it can be ROU to lease liability depending upon the situation. Clear, everyone? We'll have a question also in this one. which is your ICI illustration question number 37. Okay. Clear everyone so far? Anyone having any queries? No? Okay. Hmm. Pardon? Mm-hmm. Mm-hmm. So you are telling if in this step number 5 ROE asset becomes 0, how will it become 0? Ideally no, right? See, because see, when you are doing lease modification, you are doing in between the lease term, right? We depreciate the ROU over the lease term. So during the lease term, how will it become 0? It cannot, right? Let's suppose I have recognized an ROU asset of rupees 10, the lease term is 5 years. Can you say at the end of year 3 it will become 0? It cannot, right? Now, this is the question. I consider this question as one of the best question given in the ICI material for leases. Please try to read this question. Do you have any query? Okay, fine. If you can solve this question, I think this question covers the concept for increase in scope. This question covers the concept of decrease in scope. This concept covers the accounting for if the scope increases and that is not in line with the market rentals. Because if something is in line with the market rentals, that's a separate contract and which we can account for it anyways. Okay. Please try to read this question for 2 minutes, then I'll explain the question as well. So what happens? The question says that the lessee has entered into a lease contract for 10 years. Understand the question. The only challenge in this question is a student fails to understand this question. The rest all is very easy. 10-year lease I have taken for 2000 square meter, sorry, of office space. The annual lease payments are 1 lakh. Okay, payable at the end of each year. The interest rate implicit in the lease cannot be readily determined. Okay, fine. The incremental borrowing rate of the lessee is 6% here. So it says the lease, the discount rate is 6% here. Okay, fine. Now it says at the beginning of year 6. At the beginning of year 6 means till 5 years everything run smoothly. Okay, no challenge in that. Okay, 5 years, no challenge in the first 5 years. At the beginning of the 6th year, what I did was I took an additional 1500 square meters. Okay, that's an increase in scope. Now whenever the scope increases, what will we assess? Whenever the scope increases, what will we assess? Exactly, if the rental is in line with the market rent or not. Now see what the question says. The consideration for the increase in scope is not commensurate with the standalone price for that increase adjusted to reflect the circumstances in the contract. So it doesn't reflect the market rentals. Means what will go? We'll to case 3, right? That is lease remeasurement but at revised discount rate. Okay, see, when I'm saying lease remeasurement, don't think that it's the case of lease remeasurement. It's a case of lease modification, but we'll do the accounting as per the similar to lease remeasurement with the revised discount rate. Okay, I believe the discount rates always creates confusion. So what I'll do after I've done this with this question, I'll give you a summary of the discount rates. Okay, so you can use those discount rates and never get confused. Now, further it says reduce the lease term from 10 years to 8 years. It says from 10 years I will reduce to year 8 only. Clear everyone? Now, the annual fixed lease payments, see initially it was 2000 square feet, now it becomes 1500, so it will become total 3500. Now, definitely if the scope has increased, lease payments will increase, whether or not in line with market rental, but it will increase. Okay. Now it says the annual fixed payment for 3500 square feet is 150,000. Now, can you please tell me what is the increase in rentals? Very good. The increase in rental is 50,000. Okay, per year. Now, and the discount rate here is 7%. The discount rate here is 7%. Okay. Now, consequently, the lessee does not account for increase in scope. Okay, fine, fine. Now, how should the said modification be accounted for? Half of the work we will do, I will do, half of the work you have to do. I will explain, you will calculate. Okay. Now, this is on lease commencement date. I will write the journal entry, you will tell me the amounts. ROU asset account debit to lease liability. Tell me the amount. 7 lakh. Everyone solve this question? Okay, fine. Is it clear till here? Now, beginning of year 6 or end of year 5, same thing. Okay. Now, tell me what should be the carrying amount of lease liability and ROU asset. Pardon? 421, 236, and this one 368, I believe, right? Because just 368. Any challenges so far? Anyone? Good. Now, what happens here? The lease modification happens. Understand this part. This is my duty, and the rest will be your duty. The lease modification happens in two ways. One is increase in scope, and another is decrease in scope. Now, increase in scope, that is not in line with market rental. Agree? Now, this will do what? Will just remeasure lease liability and make a corresponding change to using revised discount rate, right? And make a corresponding change to ROU. Here, decrease in scope, separate accounting treatment, which I have already discussed. So, you can do the accounting for either of them before, okay? That's not the case that we have to first do the accounting for decrease in scope, then do the accounting for increase in scope. It's not the, in ICI material they have done this way, but you can do either ways, okay? That doesn't matter at all. So, first let's do the accounting for decrease in scope. Now, when the scope decreases, what happens? Tell me. That is from 10 years to 8 years. Now, you have to de-recognize a portion. Now, understand that this lease liability is for the remaining how many years? 5 years. But out of which I have to de-recognize how many years? 2 years. Very good. So, now what I will do is, I will tell that beginning of year 6, year 7 and year 8, right? I have to pay 100,000, I have to pay 100,000, I have to pay 100,000. Understand, a mistake that the student does in the exam. Exactly that's a mistake that we will do in the exam. If you will take 150 here, you are merging the increase in scope and decrease in scope together. Okay, so you have to keep it separate. Tell me, did you recognize the lease liability at 150,000? No, you recognized it 100,000. So de-recognize what you have recognized. Okay. Now, so and your present value will be at original discount rate 6%. Very good. Can you please calculate present value and tell me? 2,67,301. Very good. Now, this is now tell me what is the change in lease liability? See, your lease liability was how much? 421,236. Your 421,236 was the carrying amount. Now, your 267,301 is the revised amount. Now, what is the amount? 153,935. Very good. This is the reduction in lease liability. Let me write that. Reduction in lease liability. Now you have to decrease your ROU asset also. Decrease ROU asset proportionately. So what was your ROU asset? 368. This was for how many years? 5 years. This represented for 5 years. But for how many years we have to reduce? 2 years. So can you tell me what is the amount? 147,200. Meaning thereby that you have to decrease your ROU by 147,200, lease liability by 153,935, 153,935, and the difference will be transferred to P and L. What is the amount? 6735. This is the impact that goes to P and L. Clear? Now, what you will do again? You will again measure the lease liability, but at revised rate. So what we will do now? Lease liability at revised rate. Always remember that keep the accounting separate. If you will merge the accounting, you will mess up there. Okay. Now, revised discount rate again, year 6, year 7, year 8. How much? 1 lakh, 1 lakh, 1 lakh. Present value at the rate of 7%, right? Can you please tell me the amount? 2,62,432. Now, it was how much? See, 267,301. And now you have to bring it to 262,432. So you have to decrease your lease liability further. So what is the decrease in lease liability? Can you please tell me? Decrease in lease liability is 4869. Now what you will do for this one? Make a corresponding impact to ROU. So the entry will be lease liability account debit, because the lease liability have decreased, to ROU asset. Amount is 4869. Understand now one thing here. Your carrying amount of lease liability was how much? 421,245, right? 236, okay. 421,236. Your revised lease liability at original discount rate was how much? 267,301, if I'm not wrong. Now revised lease liability at revised discount rate is how much? 262,432. 432. Now this impact will go to P&L as adjusted with ROU asset. This impact will make a corresponding impact to ROU. No impact in P&L. Make a corresponding change to ROU. Is that clear, everyone? Now, still we are yet to do the accounting for increase in scope. Very good. Now, let's discuss the increase in scope. Increase in scope. Now, tell me, due to increase in scope, your lease payments has increased by what amount? 50,000. For year 6, year 7 and year 8, your increase has 50,000, 50,000, 50,000 and present value at the rate of 7%. Can you please tell me what is the present value? 1,31,216. Okay, now, so what you will do, ROU asset account debit to lease liability 131,216. Is it clear, everyone? Now, let me make a summary of it. Year 10, initially, here the lease liability and ROU was how much? ROU was 736 and the lease liability was also 736. At the beginning of year 6, lease liability became how much? 421,236. Then we decreased the lease liability by how much? 153,924. 935, okay. 153,935. Then also we decreased the lease liability by 4,869. It was 4,869, okay. 4,869. Then we increased the lease liability by 131,236. Correct? So what is the amount? Can you please tell me? 393,647. Okay. Now ROU asset was 368 here. We decreased by how much? 147,200. 147 to why 200? It should be 368 divided by 2, right? Okay, no, agree, understood. Now minus, we again decrease the lease liability by 4,869. 4,869. Now again we increase by 131,236. So what is the amount? 481. Okay. Can you please check, please? 368,000 minus 147,200 minus 4,869. 347,147. 347,147. Now this you will amortize over. Now this is not year 10, it will become year 8. Amortize over 3 years. And this also you will amortize over 3 years. Is that clear now? Though this question was a bit lengthy, but this question is a master question which I feel that you should solve a day before the exam. Okay, which will give you concept clarity. But always remember few things, that whenever there is a two different angle given in the question, okay, like increase in scope or decrease in scope. So that's the reason. See, I'll show you here. These are the 3 basic classifications. Okay. Now, if there is an increase in scope, definitely that's a separate contract which you ignore apart. Now, if same question have an instance from case 2 and from case 3, deal it separately. If a question has 2 instances, but both are from case 3 itself, you can deal it in one go itself. Okay. So that's the reason based on the accounting, I have bifurcated in this manner. Is it clear? Now coming to discount rates. Before I move further, I will have a discussion on the discount rate as well. See, ideally the discount rate we use, the confusion is only in a lease remeasurement and a lease modification. Others, I believe it's not that confusion. Lease modification. Now understand, in lease remeasurement, we'll use original discount rate ideally. But whenever there is a change in the reasonable certainty of an option, we use a revised discount rate. And there is one more exception. Whenever there is a reasonable certainty change on option plus any other estimates, right? Then also we use revised discount rate. Okay. Now comes to lease modification. In lease modification, I have told three cases. Case A, which was a case of a separate contract. Now, if it is separate contract, definitely I will take a discount rate on that date itself. Okay. So there is no challenge ideally in that. I will write revised. In case C, that is like a lease remeasurement, definitely I will use a revised discount rate only. But in case B, that is decrease in scope, case B, that is decrease in scope. So whenever the scope decreases, what you have to do is first de-recognize the lease liability and ROU at, I will not write ROU, I will write here lease liability at original discount rate. Okay, then again bring lease liability to revised discount rate. Okay, now the impact of which goes to P&L, impact of which goes to ROU. Please look at this chart and please tell me, is it clear everyone or not? Clear? Now coming to the presentation, and then we'll have a break. Now, right of use asset, we have two options. Option number one is you can show on the face of the balance sheet, or you can take it as a part of the PPE. Okay, so or investment property as the classification may be. Okay, so that's the for right of use asset. Lease liability, you have to do the classification into current and non-current. Now understand, this is an area where you can make a mistake in the exam. Now tell me, let's suppose at the end of this year I have to let's take up this example itself. Okay, let me draft a simple example so that I can explain it off and you will understand that as well. Because the understanding of the classification is important now. Of lease liability into current and non-current. Simple example I'll take. 3 years, okay. 1 lakh, 1 lakh and 1 lakh at the rate of 10%. Can you please tell me what is the present value? $248, pardon? 680. Okay. Now, this is your lease liability. Now I will ask, please calculate what is the current and what is the non-current portion. Tell me what is the current and non-current portion. So the answer which I receive in my regular classes, they say, sir, 1 lakh is the current part and the rest is non-current. Tell me then. This is what I wanted to listen. What is the current and what is the non-current? Current is 1,73,553. Okay, and non-current is 75,126. Okay. Now tell me, what do you mean by current? Means the liability, a portion of the liability which will be paid within the 12 months. Within 12 months, how much you can see being paid? 1 lakh. You can see within 12 months, you can see actual amount being paid as 1 lakh. But now see, understand, your liability here is 248,680. Okay, and you are paying 1 lakh here. But during the year you will charge a finance cost also, right? And the amount for which how much? 24868. 24868, and the liability becomes 273,555 here. So you are paying this 1 lakh from 273,555 rather than 24868, right? So we want to know that how much of 1 lakh pertains to 248680, right? So what I'll say, from this 1 lakh, and you will know this in general parlance, it's a practice that whenever we pay any repayment of any loans, whenever we do, we first adjust the interest and then we adjust the principal. So from this 1 lakh, I would have paid 24868 for the interest and the remaining 75126 for the principal. Means out of 24868, we have paid 75126 within 1 year, right? So this forms the current part. Okay, so current is not 173553, it will be 75126, and the non-current will be the rest, that is 248680 minus 75126, that comes to 173554. Is it clear? In the exam, if you will not have this time to do this much calculation, a simple way, the lease liability in the next year, the carrying amount of lease liability in the next year becomes the non-current part for the current year. Okay, that's a simple trick that you can follow in the exam. But this tricks will be applicable only for lease payments due at the end of the year. Now, if the lease payments are paid at the beginning of the year, let's suppose on 31st March you have 248680, on the 1st of April you will pay 1 lakh, right? So there is no interest component being charged between them. The full 1 lakh will become the current portion, right? In that case, so I hope it is clear, the classification into current and non-current. Okay. So though I have written in the notes also the balance of the lease liability at the end of next year, and I have explained the calculation also to you guys. Okay. So this is how in the P&L you have to charge depreciation expense for ROU asset and finance cost for lease liability. The contractual payments that you make for the lease liability will go to cash flow statements. Is it clear, everyone, so far? So now this completes our discussion from a lessee perspective. If we have any queries, definitely we can take it up. Otherwise, we'll take a break of 15 minutes and then we'll move to lesser accounting. Any queries, anyone? Okay, let's resume back. So, having discussed the accounting from the lessee perspective, now we have discussed the accounting from the lessor perspective as well, right? Now, understand, prior to Ind AS 116, there was Ind AS 17, right, on leases, which asked us to classify the lease contract as an operating lease and a finance lease for the lessee and the lessor both. But that's not the case with the lessee as of now in Ind AS 116, and we very well know the reason for that. I'm not going into that point of view. Now, the change has come from a lessee perspective and not from a lessor perspective. So the lessor still needs to classify the lease contract as an operating lease and as a finance lease. Now, the first question that comes up here is, how will we classify that? Now, once we have classified, what will be the accounting treatment for a finance lease, what will be the accounting treatment for an operating lease, that we have to study. But the first question that we have to answer is, how will we classify and whether the lease contract is an operating lease or a finance lease. The basic intent behind classification is, if the lessor has lost its interest in the asset, okay, then we can say it's a finance lease. Basically, to give an example, let's suppose I have given this calculator on lease to you guys, okay, and now I am least bothered about how you are using this asset, okay, I'm least bothered about that. Basically, in that case, it means like I have given this asset to you on finance lease. But now let's suppose I have given this asset to you on lease and put certain restrictions that you can use it only for 2 hours a day or 3 hours a day. You can use it only in this month, okay. Basically, I'm like, let's suppose any of you have taken any vehicle on rent anytime. So when you take any vehicle on rent in the Bangalore, what you will do is they'll say you can drive only up to this much kilometer in a particular day. You cannot take the vehicle out of the premises of the Karnataka region, right? So all this, why they put this restrictions? To protect its interest in the asset, right? Because they are still interested in that asset, okay? And when you are interested in the asset, even after giving on lease, that's an operating lease. And if you have lost the interest, that becomes a finance lease. Now, standard has given certain indicators to classify, and these indicators is exactly the same what was given in Ind AS 17 as well. Okay. Now, the indicators are, see this one: transfer of ownership at the end of the lease term, like the purchase option existed and the lessee is reasonably certain to exercise the purchase option. Okay. Now, purchase option, again same point I have written, but the price is very nominal. See, understand, when we were talking from a lessee perspective, definitely the lessee can assess whether it is reasonably certain or not not reasonably certain. But how will lessor estimate if the lessee is reasonably certain or not? He will not be able to do it. So then in that case, if there is a purchase option and the purchase price is such a nominal price which the lessor thinks that definitely he will purchase it off. Okay, let's suppose the price of this floor is, let's suppose, 1 lakh rupees. Okay, now the lessor has put a price, the purchase price is rupees 100. So lessor knows that this 100 is such a nominal price that anyone can pay and purchase it off. Okay, this is a value for money. So in that case also I can say it's a finance lease. The present value of what I'm getting, as a lease payments, the lessor is getting, okay, that covers around 90% of the cost of the asset or the fair value of the asset. Okay, so basically through this lease contract I have recovered almost 90% of the value of the asset. Okay, so then also you can say it's a finance lease contract. The lease term, let's suppose the life of the this calculator is 3 years and I have given it to you on lease for, let's suppose, 2.5 years. Again, for majority of the life I have given it to you. Okay, but understand the standard says substantial part. Okay, standard says substantial part, but the standard doesn't define the substantial part. So what you have to do is, for the exam, consider 90% substantial here, consider 70% substantial here, and this quantification has been taken from ASC 842, that is from a US GAAP. Okay, so not required to know these names, but yes, just for an information I'm telling it to you. Okay, now the asset is of such a specialized nature that only lessee can use. Now let's suppose we have got this class designed in such a manner that no one else can use this class. Okay, and at the end of the lease term, the lessor will not be able to use this class in any other manner. Okay, or not, the lessor will not be able to give this class to anyone else on lease. Okay, so the lessor will have no option other than to give it on lease to me itself. Okay, so that is also called a specialized nature, where the lessee can only use this and when any of these conditions gets satisfied, or I'll say any of these indicators get satisfied, we can say it is a finance lease. It's not an operating lease. It's not an operating lease. Now tell me, are these indicators an exhaustive list? No, they are just an illustrative list. They are just an examples. They are indicators. Okay. Now, so now on the basis of these 5 indicators and on the basis of the intent that I told, we will definitely be able to classify whether the contract, the lease contract, is a finance lease contract or an operating lease contract. Now, once we have determined whether it is an operating lease or a finance lease, now comes the question: how will I do the accounting treatment for that? Okay, the accounting treatment for operating lease, I believe, is very much clear to all of you. We record the rental income in the P&L over straight line basis. Okay, over the lease term. Straight line basis, if I have to give an example, let's suppose 3-year lease term. 3-year lease term. Listen to the question properly, guys, all of you. 3-year lease term. The rental for the first year is 5 lakh. The rental for the second year is 10 lakh. The rental for the third year is 15 lakhs. How much will I record in the P&L in the first year? 5 lakhs, 10 lakh and 15 lakh is what I will receive in each of the year. First year, how much will I record in the P&L? 10 lakhs. Anyone with a different answer? Anyone with 5 lakh as the answer? Anyone? No? Okay, fine. So 10 lakh is the answer, and this method is called as straight line method. Okay. So that's an accounting for operating lease. Now coming to the accounting for finance lease. Now again the accounting remains the same. Understand? What I told is when it's a finance lease, you have lost the interest in the asset. Basically, it's like you have sold the asset. Tell me, when you sell an asset, what is the entry that you pass? Bank to asset. Basically, we de-recognize the asset, we recognize the sale proceeds, and we recognize the gain or loss on sale, right? Let's suppose I have sold the asset, but I have not received the money which I will receive in the future. Then receivable account debit to asset to gain or loss on the sale. See the same entry. Trade receive here it will be lease receivables, because this receivable in the nature of lease, right? So lease receivables account debit to asset to P&L. So journal entry I believe is clear to everyone. Now comes the amount. Tell me, link again with the asset. When we de-recognize the asset, we de-recognize at its carrying amount, right? So same is written here. De-recognize the asset at its carrying amount. Now I have de-recognized asset. Now we have to see that from this asset, what I'm going to receive. First, I will receive the future lease payments from the lessee. Now, if you can recall, there was a component that I didn't include in lease payments from a lessee perspective. The unguaranteed part of the residual value, right? See, from this asset, everything will be received from the lessee. But the lessee will either not give the residual value, or even if it gives, it will give the guaranteed portion only. It will not give the unguaranteed amount, right? So what I will do here in lease receivable, I will write here the present value of the future lease payments plus the unguaranteed residual value. Is it clear, everyone? Because why I am taking it here separately, because it is not a component of the future lease payments. Clear? So this accounting treatment I believe is clear to everyone. The challenge in this one. So what happens? Understand, I am the manufacturer of the product. Okay, my business is not to give on lease. My business is not to give on lease, but I have given asset on lease to someone. If I will do the accounting this way, will I be able to record any revenue? See, I will not be able to record any revenue. But see, understand, for any entity, for any manufacturer, what is the most important line item in the financial statements? The revenue, right? So if I am doing multiple transactions during the year pertaining to the lease, but my business is not to give the asset on lease, so definitely it will impact my revenue. So standard says that when you are a dealer or a manufacturer of that particular product, you are not required to do this accounting treatment. Rather, you are required to do this accounting treatment, and you will when I take a number and explain it to you, you will see there is no impact in the P&L from a profitability perspective. Okay, only the presentation changes. Now, what is the meaning of revenue? The gross receipts that you take from an ordinary course of business. Now tell me, from this particular asset, what is the amount that I receive from the customer? Future lease payments, only future lease payments, not unguaranteed residual value, because unguaranteed residual value I will not get from the customer, I will get by selling the asset at the end of the useful life, right? So this, so this amount which I receive from the customer becomes my revenue. Now come here. When I record a revenue, applying the matching concept, I have to recognize the cost of sales also. Now, what is the cost of taking this revenue? The cost of the asset. Now, definitely the cost of the asset, but at the end of the life of the asset, you will realize something called as unguaranteed residual value as well. So the cost of sales is not the actual cost of the asset, but rather it's the cost of the asset as reduced by the present value of the unguaranteed residual value, right? So that's the actual outflow from the company perspective. So now see here, that's what we are doing here. We are recording the lease receivable as the present value of the unguaranteed residual value. and we are de-recognizing the asset, and the balancing figure goes to the cost of sales. So what happens is the cost of sales becomes cost of asset minus present value of unguaranteed residual value. This is what is the cost of sales. This is what is called as cost of sales. Is it clear? Now, definitely, I believe you would have understood why this accounting treatment is being done. But I believe that you should also understand the accounting treatment, that is this accounting treatment does not have any impact in the P&L apart from the presentation. Okay, let me take up a question and explain it to you. Okay, just a simple question I'll take up, simple example I'll take up, very simple. Let's suppose I have given the asset on lease for 3 years. Okay, now the lease rentals are 1 lakh per annum. Okay, the discount rate is 10%. Now here, can you please tell me what is the amount of lease receivable? 248,680, if I'm not wrong, correct? Now, let's understand side by side both of them. What will the accounting treatment for a normal lessor? He will, and the cost of the asset you can write here, cost of asset is, you can write here 2 lakhs. Okay. Now, so lessor will record lease receivable account debit to asset to P&L, that is gain or loss on the finance lease. It will be 248,680. Asset will be 200,000. P&L will be 48,680. Clear? Now, if you come to the P&L, you will record what? You will record gain or loss on sale 48,680. Right? Now, let's discuss for a dealer. He will record lease receivables account debit to revenue. Very good. And say that it is 248,680. Now he will say cost of sales account debit to asset amount will be how much? 200,000. Agree? Now let's prepare P&L for it. The dealer will say my revenue is 248,680. My cost of sale is 200,000. My profitability is 48,680. Does the profit change? But the presentation changes, right? So this separate treatment is just from a presentation perspective and not from an impact perspective. The impact remains the same. Whether the dealer or the normal lessor, both will unwind the lease receivable every year and record finance income. Okay, and both will receive the contractual payments. Okay, but the presentation will change for both of them. Is it clear, everyone? Now, subsequent accounting treatment for a finance lease. So what we do again, lease receivable is a what? Is a finance asset, is a financial asset. What is the meaning of a financial asset? Contractual right to receive cash or any other financial asset. When there is a lease is a contract, so it gives a contractual right. This will be settled how? By receiving the cash flows, right? So contractual right to receive cash flow, it's a financial asset as per Ind AS 109. Now I will record as opening lease receivable plus I will charge finance income minus I will receive the lease receipts. Now just one quick question. The lessee will account for the contract under the incremental borrowing rate or the implicit rate, and implicit rate was given a priority. But I told that in general practice we'll use interest rate incremental borrowing rate. But for a lessor, we'll use what? The lessor will actually know the interest rate implicit, right? So we'll use interest rate implicit in the lease. But again, if the question does not specify, you can use either of the discount rates, whichever the question specifies. Okay. Now, so one more thing, that the question will not test you in interest rate implicit or you can say incremental borrowing rate. Okay. the question will give you only one of the discount rates. But if in rarest of the cases, if the question give you both the rates, give priority to interest rate implicit in the lease, okay, whether it's a lessee or the lessor. If the question at all asks you a question on that, okay. Now tell me, operating lease we have already discussed. Now, when the Ind AS 17 got transited to Ind AS 116, the change in accounting was from a lessee, not for a lessor. So lessor still used to do the accounting for operating lease and the finance lease, but the lessee is only one single lease accounting model. So the accounting became more strict for lessee. So the lessee required certain relaxation, and that's where the recognition exemption was given to lessee. Okay, so understand this recognition exemption is only to the lessee and not to the lessor. It's not available to the lessor. Okay, now, and when will this recognition option be available? When the lease term is less than or equals to 12 months. The mistake that is being done by the students is when the lease term is 12 months, they think that it will be a finance or that this recognition exemption will not be given. No, up to 12 months recognition exemption is there, up to 12 months. Okay, 12 months, 13 months recognition exemption is not there. 12 months it is there. Okay, so that's the reason why I've written here equals to. Okay, now, or if the lease is of a low value item, to give an example, a mobile phone, to give an example, a laptop, like let's suppose you have taken this building on lease, it's not a low value item. Okay, so that's the reason. Now, again, the standard says that if the lessee opts for this exemption, you have to record the expense in the P&L over a straight line method, and I believe you already know the meaning of straight line method, right? So basically 5, 10, 15, year 1, year 2, year 3, you will record 10, 10, 10, right? Is it clear everyone so far? The accounting for the lessor also. Now, coming to the sale and lease back accounting, and I'll say this concept or this topic is the favorite topic of the examiner. Okay, sale and lease back. Now understand the meaning of sale and lease back first because if you understand the meaning of sale and lease back, it becomes quite easy to understand the accounting treatment also for that. Now understand. So what happens? Entity wants to, basically this concept was brought in India by a company called Indigo. I believe all of you know the name of it, right? So now what happened? Indigo, when it came to India, the aviation sector was fully into losses. Okay, now they wanted to convert this industry into profit making industry. So now what they thought that initially they used to purchase the flights and then operate, but in what Indigo planned, Indigo thought, I'll not purchase it off, rather I'll take it on lease from the German company. But definitely they will not, the German company will not give this much expensive assets to on lease to an Indian startup company, right? So what Indigo did, Indigo purchased the asset. Okay, but when he will purchase one flight cost around 2000 crores and he purchased around 200 flights, so you must can assume the amount, right? So for a startup company, that's a very huge amount. So how will Indigo try to cop up with this one? So what Indigo did, it went to the bank to sell this asset. So what Indigo did, Indigo sold the asset to the bank. But now what will bank do with the flights? So what Indigo did, Indigo took the assets back on lease. So now what was the issue of Indigo? Cash crunch. When I sold the asset to Indigo or to bank, this issue is resolved. Then another issue came up was, what will bank do with the flights? Then again, what Indigo did was took the asset back on lease. So that issue also got resolved. What was the original intent of Indigo? To take the asset on lease. Is that followed? Yes. But yes, a different route was taken, right? Now what happens when we sell and then take out on lease? So what happens when you sell? You lose the 100% control over the asset. But when you take again back on lease, you regain a percentage control over the asset. So keep in mind this line. But when you sell, you lose 100% control. Okay, because this statement will help you in understanding this concept in a better manner. But when you take it on lease, you regain X percentage control. I am not saying 100% control, I am saying X percentage control. Okay, because when you take the asset on lease, you get the right to use that asset, but you don't become the owner of that asset. Okay, so you regain X percentage control of the asset. Now tell me, what is the journal entry for a sale? Bank account debit to asset to gain or loss on sale. Agree? What is the journal entry for a lease? Tell me. ROU to lease liability. Now, can I say the journal entry for sale and lease? The journal entry for sale and leaseback is just a combination of these two entries, right? So this entry you already know, this entry we have already discussed, right? So just combine these two entries and it will become a journal entry for sale and leaseback. And I'm not saying it like this. See here, bank account debit, ROU asset account debit, ROU asset account debit, to asset, to lease liability, to gain or loss on sale back, to gain or loss on sale back, right? This is the entry for sale and lease back. Now, the entry is not the challenge in sale and lease back, that everyone can pass. The challenge becomes a number, the measurement. And the most challenging here is ROU asset. Okay, but that is very easy if you understand it logically. Understand it. First, I will explain the easy ones and then I'll explain the ROU asset. What is the amount for bank? Tell me. Sale proceeds. What is the amount for lease liability? Present value. What is the amount for asset? Carrying amount. Okay. Gain on sale or leaseback. This is the balancing figure. Now comes ROU asset. Please listen carefully to what I'm saying now. When you sold the asset, you lost 100% control. Means de-recognize at carrying amount. Clear? Now, when you again reacquired on lease, reacquired the asset back on lease, you regained X percentage control. So far, we used to recognize ROU asset as the what is the amount for lease liability plus the upfront lease payments plus the initial direct costs. But here it says you are acquiring an asset which you already owned previously. Okay, so you de-recognize that when you sold. When now you are getting X percentage control. So don't you think it should make more sense if you recognize ROU at X percent of carrying amount? Right? Because what is happening ideally? What is happening ideally? You had asset, 100% control you had, so you are recognizing at its carrying amount. You sold the asset, you de-recognize the whole asset. You reacquired the asset on lease, you regained X percentage control. So better recognize that X percent of the carrying amount. That's what makes sense logically. Now question comes up now is, what is the value of X percentage? How to determine that? How much control you have acquired? What is the percentage control that you have acquired? Tell me, let's suppose the value of this full building is, let's suppose 10 lakhs, okay? And I have paid 3 lakhs rupees. Tell me how much control I have got for this building? 30%. So can I say X percentage means amount paid divided by amount to be paid to acquire 100%, right? Now amount paid is denominated by lease liability, right? And amount to be paid to acquire 100% is denominated by fair value. So can you say your ROU asset is equals to lease liability divided by fair value into a carrying amount? Does this logic make sense now? So far we used to just remember this formula, right? So please don't remember anything. Try to understand the logic and things becomes much clear to you and much easy also, I believe. Is that clear, everyone? Now, can we solve a question on sale and lease back? Let's solve it. Just ignore this last line as of now and please try to solve it. What does the question say? It says entity, a seller lessee, sells a building to another entity, that is the buyer lessor, for cash of 27 lakhs. Means this is the sale proceeds. This is the sale proceeds. Immediately before the transaction, the building was carried at a cost of 15 lakhs. This is the carrying amount. Now, at the same time, the seller lessee enters into contract with the buyer lessor for the right of use of the building for 20 years with the annual lease payments of 200,000 payable at the end of each year. This is the lease payments. Now, the terms and conditions of the lease are such that the transfer of the building by seller lessee satisfies the requirements for determining when a performance obligation is satisfied in Ind AS 115 revenue from contract with customers. Now, what does this line say? It says when the Indigo sold the flight to the bank, okay, do you remember in Ind AS 115 we can say that the performance obligation is satisfied only when the control gets transferred, right? So it says this will be treated as a sale contract only if it satisfies the control criterion of Ind AS 115. Okay, so if the control is transferred, this is a sale. Okay, now a question might arise in your mind that sir, what if this control is not satisfied? Okay, I'll try to answer, I'll answer that also, but first let's solve this question. Okay, now okay, so it says the fair value of the building is 27 lakh, means you have sold at fair value. Okay, the initial direct cost, if any, are to be ignored. There is no initial direct cost. Basically, interest rate implicit in the lease is 12%. Now, just going not from an exam perspective, but only from a knowledge perspective, how come, see, Indigo is a lessee now. How come lessee knows interest rate implicit in the lease? Pardon? No, interest rate implicit in the lease is the rate of return, the profitability margin. How will Indigo know the interest rate implicit in the lease? Tell me, in this story of sale and leaseback, who is the hero? Indigo. Who is doing this all this transaction? Indigo. So don't you think Indigo will know all the profitabilities? Right? Indigo will know the rate of return from these investments, right? Because the initial investment was done by whom? Indigo, right? So that's the reason why Indigo will know the interest rate implicit in this case. Is it clear, everyone? Now, not required from an exam perspective, but just from a knowledge perspective. Okay. Now, the buyer lessor classifies the lease of a building as an operating lease, not required. Okay. Now, how should the said transaction be accounted by the seller lessee and the buyer lessor? Okay. I'm not discussing for the buyer lessor. I'm discussing only for seller lessee as of now. Okay. Buyer lessor will do the normal accounting treatment as it's an operating lease. Okay. Now, let's discuss the accounting treatment. Just a minute. So let's Pass the journal entry separately, sale and lease back. Sale will be bank account debit, 27 lakh, very good. To asset, how much? 15 lakhs. To gain or loss on sale, 12 lakhs. Clear? Lease back, ROU asset to lease liability. Now the lease liability, can you please calculate the present value? 1493. Can I write here 14.94 lakhs? Now ROU asset. So it will be carrying amount multiplied by lease liability divided by fair value. So carrying amount is how much? 15 lakhs. Lease liability is how much? 14.94. Fair value is how much? 27. So what is the amount? 8.3. Okay. 8.3 lakhs. Now where will the differential go? Where will the differential go? Now understand this part. We have recognized the gain or loss on sale 12 lakh, sorry, right? Now this 12 lakh, don't you think represents the gain or 100% asset, right? But when we take the asset back on lease, we reacquire certain percentage control, meaning thereby we have to recognize the gain or loss on 100 minus X percentage, right? Because net it's 100 minus X percentage control that is being lost, right? Because 100% we lost initially, X percentage we reacquired, net is what we lost. So this is the reversal of the gain that we have booked here. Okay, reversal of the gain on the control that I have reacquired by a lease transaction. Okay, I'll prove this number also, don't worry. So here it will be P and L account debit. What is the difference figure? Can you please tell me? Pardon? 6.6 lakh, is that correct? Is 8.3 correct? Just I am little bit skeptical. 15 into 14.94 divided by 27 is 8.3. Okay, fine. It's by 6.64. 6.64 lakhs. Okay. Is it clear, everyone, so far? Now, passing the journal entry for sale and lease back, it just you have to merge these two entries. But now let me explain you these two figures. Okay. Now, can you please tell me what is the control that I have regained? 14.94 divided by 27 is 55.3%, 33%, can I say, is what I have regained. Now, think of it this way. When I sold the asset, I recognize the gain or loss on 100%, that was 12 lakhs. When I acquired the asset on lease, you can say I will reverse gain or loss on 55.33%, right? Now can you please calculate 12 lakhs multiplied by 55.33%? Is it 6.64? Is it the same figure? Right? So that's what we reverse, because this is the control that we have reacquired, and we record gain or loss only on the control that I transfer, not on the control that I retain. Clear? Now, so what is the net gain or loss that I will recognize? 12 minus 6.64 is 5.36. Clear? Now, just combine these two entries. You will get bank account debit, ROU account debit, then to asset, to lease liability, to gain on loss on sale and lease back. Just put the figures. Bank is 27, ROU is 8.3, to asset is 15, to lease liability is 14.94. Can you please find the balancing figure? Without finding, I can say it will be 5.36. Is it clear, everyone? Very good. Now, read this line now. Please read this line now. Means I have sold at a value which is higher than the fair value. Tell me, this calculator is worth 300. Will you purchase it for 400? Why will you purchase? You will say that, sir, if you want to sell it 400, I will not purchase from you, I will purchase from the market at 300, right? So that's what, in general parlance, why will anyone purchase at a price higher than the fair value? No one will, right? Now what will happen, if the lessee is trying to sell the asset at a higher value, then don't you think the bank will also recover 3 lakh extra from the lessee by way of increased lease payments, right? Because see this transaction, see, if you sell this at higher value, if the Indigo sells the asset to bank at a higher value, the bank will recover the money from the Indigo a higher lease payments, right? So that is not a lease transaction, that is basically, you can say, a finance loan, a finance liability, right? So what you will do in this case, see, you will have to record an additional financial liability amounting to 3 lakhs. That's all you have to do. Is that clear, everyone? Okay, now, and how the journal entry will change? Let me show that as well. Right here. Sale and leaseback, sale proceeds higher than fair value. Now, again, bank will receive 30 lakhs. ROU, I'm keeping it blank as of now. Then, to asset at 15 lakhs. To lease liability, to financial liability, I'm keeping it blank. To gain or loss on sale and leaseback. Now, see, what was the present value of the future lease payments? 14.94. 3 out of which was a finance liability, right? So the remaining will be lease liability now. Now what will happen? Your balance of lease liability has changed. So don't you think your ROU will also change? So now what will be the value of ROU now? Your ROU will be 15 multiplied by 11.94 divided by 27. So what is the value? 6.63. And now what is the value of gain on sale on leaseback? The balancing figure? $6.69. Is that clear to everyone now? Okay, fair enough. That completes our concept of sale and leaseback. Moving on to the next concept, that is sublease. Okay, though there is a notion that sublease is a very difficult concept, but I'll say sublease is not itself a concept. Sublease is nothing. Okay, if you have understood everything so far, sublease is just a replica of that. Okay, now what happens in a sublease? I take this property on lease, give it to someone else on lease. That's all. Now, this is there are 3 parties involved here. Agree? So what happens? This party gives it on lease to this party. So for this contract, A is the lessor, B is the lessee. Okay. Now, again, what B does is B again gives it on lease to this party, right? Now, okay, what I have done here is, understand, lessor and lessee is there. Okay. Now, again, for this contract, B is the lessor and C becomes the lessee. Now, see, for accounting for A is very simple, lessor accounting. Accounting for C is very simple, lessee accounting. The accounting becomes difficult for B because he is a lessor also, he is a lessee also. Now, how will I do the accounting treatment for that? Understand. Which accounting treatment do you think is easy, the lessee or the lessor accounting? Lessor. Okay. Which one is for which one there are less judgments involved? Lessee. Because in lessor you have to apply whether it is an operating lease or a finance lease, right? So standard says first do the accounting treatment as a lessee. Okay, because that's the first contract also which you entered. What you will do? ROU to lease liability. Now think of yourself as a lessor. In the lessor, what we will do? Okay, I am an operating lease or a finance lease. If operating lease, record lease rentals in the P&L as rental income on straight line method. If it is finance lease, what you will do? We de-recognize the asset. Which asset is recognized here? For a finance lease, we de-recognize the asset, right? Which asset is recognized here? ROU asset. So we will de-recognize the ROU asset in this case. Okay, we'll de-recognize the ROU asset, we'll recognize the lease receivables. Any difference will be transferred to P&L. Clear? Now see here, for A, the only lessor, we apply lessor accounting, no challenge. For C, we'll apply the lessee accounting, no challenge. Sorry. For B, which is an intermediate lessor, because he becomes lessee initially, then the lessor accordingly. Okay, now, so what we'll do, apply the lessee accounting in the capacity of a lessee, then apply the lessor accounting in the capacity of being a lessor. Now, when you apply the lessor accounting in the capacity of being a lessor, you have to classify whether it's an operating lease or a finance lease. Now, if it is an operating lease, you will transfer rental income to P&L. If finance lease, de-recognize ROU and de-recognize the lease receivable, any difference will be transferred to P&L. Okay. One question remains unanswered. How will we classify whether this contract is an operating lease or a finance lease? No, not the same rule applicable. In this case, it says if the lease term of the sublease, forms the substantial part of the original lease, okay, that is called as head lease, okay, then you can say it's a finance lease. Read this part. Please read this line. It will be classified as finance lease if the lease term of the head lease is substantially equals to that of the sublease. Compare original lease terms. Don't compare revised lease terms, or don't compare the remaining lease terms. Compare the original lease terms of the head lease and the sublease. Is that clear? Now, why I'm saying compare original? Understand? Let's suppose I took this property on lease for 10 years. Okay, I have already used the building for 6 years. Okay, now I'm remaining is 4. Now I'm giving it to someone for 3 years. You will say, sir, it forms 75%. It is substantial. It's a finance lease. No. Compare 3 with 10, not 3 with the remaining. Is it clear? So that's what is the concept of sublease. Is it clear, everyone? Any queries? Which part? Okay. So what I'm trying to say, see, we definitely understood that for lessor, that is party A, it will apply lessor accounting. I'm just recapitulating everything. For A, will apply lessor accounting, no issues. C will apply lessee accounting, no issues. B becomes lessee initially and then lessor also. So what you will do, first apply lessee accounting, recognize right of use, recognize lease liability. When it becomes lessor, we have to analyze whether it's a finance lease or an operating lease. If it's operating lease, we will record the rental income in the P&L over the straight line over the lease term. If it's a finance lease, what do? We'll recognize the lease receivables as the present value of the future lease payments. We'll de-recognize the asset, but the asset that is recorded here is ROU asset. So we'll de-recognize the ROU asset. The difference will be transferred to P&L as the gain or loss of the finance lease. The question that remains unanswered here is, how will I classify whether it's an operating lease or it's a finance lease? So standard says compare the original lease term of the sublease and the head lease. Head lease means the lease between A and B. Sublease means between the lease between B and C. Okay, see, I have written here also. Head lease, sublease, right? Compare the original lease terms of the head lease and sublease. If the sublease forms substantial part of the head lease, it's a finance lease, otherwise it's an operating lease. Clear? Now, that's the accounting for lease. Now comes some theoretical topics. Initially, we understood, is it clear everyone so far? We can move on to the next topic? Okay, good. Now, initially we studied that the lease is a contract which gives the right of use of an identified asset for a specified period of time in exchange of consideration. right? The 5 components of lease. But to apply the lease accounting, we need to assess whether the contract which is given to us is a lease contract or not. Is a lease contract or not. Though from the definition also we can find out whether it's a lease contract or not. But the standard gives us a guidance on that. Okay, that how exactly we will identify whether the contract is a lease contract or not. Now, and the conditions which are given need not remember anything separately. Just tell me 2 things. First component is lease is a contract. Okay, assume it's a contract, legally enforceable document. Second is what? Identified asset. That becomes first condition. See, identified asset, condition number 1. Second condition is what? Right of use. Right of use. Now, in right of use, I say it's control. You get the control. Can anyone tell me what is the meaning of control? Can anyone tell me what is the meaning of control? No, that you are telling from a lease perspective. Tell me in general what is the meaning of control. Let's suppose I control this calculator. What can I say? I'll say I can use this calculator in any manner I want to. If any benefits comes from this calculator, it will be mine, right? See, that's what is given here. I have the right to direct the use of the asset, right? I can use it in any manner I want to. I have the right to retain substantially all the economic benefits, but now I do have the control. But can I have the ownership, or I do have the control only to use? Only to use. So I will get the benefits only from the use or from the ownership also? Only from use. So all the economic benefits from use, right? So this is what is the meaning of control. So what happens? I will say these 2 conditions represents control. Okay, this condition represents identified asset. And now what was the 4th component? A specified period of time, which is covered in lease term. What was the 5th component? In exchange of consideration, which is covered in the future lease payments, right? So do you think now all the 5 components are covered everywhere? So now let's study what is the meaning of identified asset, what is the meaning of the further 2 conditions. Okay, now identified asset, standard says 2 points in this one. First point is the asset has to be specified. Now the manner of specification, let's suppose I enter into contract with you guys that I will give you this building on lease. Okay, then it becomes explicitly specified. I am specifically mentioning that I will be giving you this particular class on lease, right? That's called explicitly specified. But now what happens if the asset is not specifically specified in the contract, but the lessee and the lessor both knows that which asset will be made available to them? Okay, that's called implicitly specified. Let's suppose I'll tell you a building was being constructed. I wanted to take a flat on lease there, okay, in that building, but the building is still under construction. Okay, I told to the owner of the building that I need a right corner flat. Okay, but can the flat be identified with the number that flat 201 or 202? No, because the building is still under construction. So will in the contract will it be specified flat number? No. So is it explicitly specified? No. But don't you think the lessee knows that which asset will be made available to them, right? So this is also a manner of specification which is called as implicitly specified. Okay, and it's totally fine in that. So standard says the asset can be explicitly specified or can be implicitly specified, and it's totally fine. Okay, now, but the important point to be noted here is no substantive substitution rights with the lessor. If you'll ever go to railways or to the airports, you'll find the vendors, okay, and different times you'll go, you'll find they have placed their stall at different places, right, and they have to pay the rental for that. But tell me, are they getting any specific place? No, they will not get any specific place. So what happens? The airport authority doesn't give them an identified space, doesn't give them they can place their stall anywhere they want to, or depending upon the requirements of the airport or the railway station. So what happens? This condition says that the lessee should have the right to use the asset in any manner they want to, or to put it another way, lessor cannot substitute the asset whenever they want to. Let's suppose I am using this calculator. Okay, I've taken this on lease. I'm using this calculator. Okay, the lessor comes very next day and says, Vishal, I don't want to give this calculator to you because I am getting a better price for this calculator. So better give this calculator back to me. I will give you another calculator. So what is happening? The lessor is having the practical ability to substitute the asset that is given to me, and that is giving economic benefit to the lessor, right? So in that case, we can say this asset is not identified asset. Okay, so that's where the condition says no substantive substitution rights with the lessor. Let me give one more example. I took a flat on rent. Okay, I took a flat on rent for a rental of, let's suppose, 30,000 per month. Now what happened? After the COVID, my landlord came to me and said, Vishal, I am getting a rental of 50,000 now. Okay, so what I'll do is I will give you another flat. You vacate this flat and I'll give you another flat because I'm getting a better rental for this one. So what happens? The lessor has the practical ability to substitute the asset here, and the lessor is having economic benefits also, right? So if this is the case, we say that the lessor has substantive substitution rights. And if the lessor has substantive substitution rights, this is not an identified asset. Okay, and how to assess whether the lessor has substantive substitution rights? The lessor will have the practical ability and the lessor will have benefits of substitution. Now, let me take up one example. Let's suppose I have taken a truck on a rent. Okay, I have taken a truck on rent. Okay, for, you can say, transportation purposes. Now, for 5 years, after 2 years, the truck becomes damaged. Okay, and I have to give it for repairs. So what I did, I give it to repairs to the lessor for a period of 5 to 6 days, and the lessor give me a spare truck for those 5-6 days. Will it count under substantive substitution rights of the lessor? No, because here the substitution of the truck is being done at the option of the lessee for the benefit of the lessee. Okay, not for the lessor. Okay, very good. So that's the meaning. So now, just if I have to say here, if the asset is explicitly specified plus it is no SSR with lessor, we can say identified asset exists. Or if the asset is implicitly specified as well, but no SSR with lessor, okay, then also identified asset exists. But if the asset is explicitly or implicitly specified but SSR is with lessor, then identified asset does not exist. Is it clear, everyone? Now this is the meaning of identified asset. Now condition number B, right to obtain substantially all the economic benefits from use of the asset. Now understand what happens here is, by virtue of a lease contract, when I take any asset on use, okay, I am having the control for that lease period. So whatever economic benefit that comes from the asset, from using the asset, will be mine. Okay, and if that is happening, this condition number B gets satisfied. Okay, condition number 3, right to direct the use of the asset. See, now understand, if I have taken an asset for a 5-year period, I can use asset in any manner I want to. Okay, now there is one exception for this, which I'll explain now itself. What happens is, let's suppose I have taken a machine on rent. How much to produce, when to produce, what to produce, how to produce will be decided by me and not the lessor. Okay, so basically all the operating decisions pertaining to the asset will be taken by me. When I say I will take all the decisions, can I take the decision to sell the asset? No, right? So I have the right to take operating decisions for the asset. Okay, I have the right to take how and for what purpose the asset will be used. See, understand, if you are noticing it, I am just focusing on the use. how the asset will be used or how the operating decisions will be taken. I have the right to this one, but I cannot have the right to sell the asset or to pledge the asset or to give it on mortgage to anyone else, right? I don't have those rights. I have the right to use the asset, and that right I can exercise in any manner I want to. Is that clear? So these are the three conditions. If these three conditions gets satisfied, okay, I'm saying here, I'm writing here and if these three conditions get satisfied, I can say that it is a lease contract. It is a lease contract. Okay. But now one exception, understand. Yeah. As I was saying it, let's suppose if you take a vehicle on rent, it will definitely put some restrictions on that. That you can drive only 2000 kilometers a day, you can drive only within the Karnataka region, you cannot take the vehicle outside this region, you will not destroy this asset. Okay, why? Because the lessor is still interested in the asset, right? So now these rights will not impact the classification of a contract to be a lease contract, okay, or not a lease contract. These are called as what? Protective rights. Very good. Contract may include terms and conditions to protect the supplier's interest in the asset. It includes maximum amount of use of asset or use the asset within a specific territory, etc. Okay, so this is called as, these are called as what? Protective rights. Now, important tip for the exam. If a question comes up in the exam to assess whether this is a lease contract or not, remember that till the time it is not proved that it is a lease contract, do not use the term lessee and lessor. You have to use the term supplier and customer. If you write the term lessee lessor, you are gone. You will not get even a single mark for that answer. Why? If you write lessee and lessor, means you are presuming it is a lease contract, and that is what we have to assess here. Okay, so never use the term lessee and lessor in a question which asks you to assess whether it is a lease contract or not. Always use the term supplier for the lessor and customer for the lessee. Is that clear, everyone? Okay. Can you please read this example? Example number 1. So what was the condition number B? Right to obtain substantially all the economic benefits from use of the asset. Basically what happened, I took a solar farm on rent, okay, for producing electricity. Now under income tax laws also I get the deduction for it, okay, so that is also one of the economic benefits. Now, but me as a lessor, will I get the tax deduction? No, that will be taken by the whom? To the one who has owned the asset, the owner of the asset. Okay. Now, so I am not, so from the solar farm, I write here, from the solar farm, we get these benefits, the tax credits. Okay, then revenue from sale of electricity. Okay, and renewable energy credits on production of electricity. Now, tax credit will be taken by whom? Owner. Now, revenue from sale of electricity will be taken by me. I am the lessor. Lessee. I have generated the electricity, so it will be taken by me. You can say customer. Renewable energy credits is given to the person who generates electricity. Again, it will be taken by the customer. Now, when I am considering this part, see, when I am assessing right to obtain substantially all the economic benefits, when I am assessing substantial part, what will I do here? I will do 2 by 2 or I will write 2 by 3. Tell me what? 2 by 2. Because I am not considering this in the option itself. Right? Because that is I don't have the right to receive itself. I have a right to receive this part. Okay, if I am receiving this, fine. I have to assess whether I am receiving substantial part of these two or not, is what I have to assess. Is it clear, everyone? Good. Read example number 2. It just says that the protective rights do not have any impact on the assessment whether the customer X directs the use of the asset or not. Clear, everyone? Good. Now, separating lease and non-lease components. First, understand what is the meaning of lease and non-lease components. Whenever we take any, let's suppose any property on rent, okay, what happens? They charge us for maintenance as well, right? Is that maintenance a lease component? No. They charge us for electricity also. They are charged for water also. Basically, they charge for utilities as well. So those utilities are not of lease. They are consumption based. Okay. So that's a non-lease component. But the rental which I am paying for the, you can say, property which I have taken on rent is a lease component. Now the contract can be structured in any manner. It can be structured that this is your payment for utilities, this is the payment for rental, separately identified. Or it can say this is the one-time payment, this is the payment that you have to do, which will include the payment for rental, payment for rent, utilities, everything. See, the structuring of the contract between two parties depends upon their decision, depends upon their mutual negotiation. It is not dependent upon what is said in Ind AS. Okay, it is dependent upon their mutual negotiation. Now, standard says that I am giving a practical expedient that if you want, do not separate. Do not separate. Do not separate. Account for it as one only. Okay, that is account for lease and non-lease component as lease component itself. Okay, but if you want to, so this is option number 1. Apply practical expedient and do not separate. But option number 2 says if you want to separate, you have to separate in the ratio of their standalone price. Meaning thereby, let's suppose it says that you have taken a flat and you are paying 30,000 for it. You are paying 30,000 for it. Now it says in this you have got the flat also and you have got the common area maintenance also or utilities also. The price for this is 28,000 if I will pay individually, and the price for this is 4,000 if I pay it individually. Okay. Standard says that break this 30,000 to flat and common area maintenance in the ratio of 28:4. Is it clear, everyone? So this is how you have to break into, or you can say allocate to CAM and to flat. Similar type you have studied somewhere else also. Can you please tell me where? No, somewhere this ratio allocation in the standalone price you have studied somewhere else also. 115. Very good. Step number 4. Very good. So now, what is the meaning of non-lease components? It's given admin costs, house taxes, municipality taxes, insurance cost, utilities, common area maintenance, etc. or the you can say non-lease components. Is it clear, everyone? Anyone having any queries now? This completes our discussion on Ind AS 116 leases. I'm stopping here for the queries. Come on, guys. Yes, please. Yes, tell me your query. Okay.
So, but the installment 2 lakh is not different. Only the sale value is different. Why we are reducing that financial liability from the lease?
Okay. See, your question is basically, which makes very much logical question, is this say if the sale value is higher than the fair value, why are we adjusting this 3 lakh from the present value of the future lease payments But if I have said that these lease payments will also increase, right? Totally a valid question. But I'll accept my fault. It's a defect in the question drafting. Okay, but the question will come in the exam also like this itself. But think practically. Think practically. If practically the sale price will be higher than the fair value, don't you think they will increase this lease payment from 2 lakh to 2,30,000 or 2,40,000? That's what will happen ideally in the practical cases. But in this case, I've not taken a separate question. For that, I have to take separate question. Just I have included a line in this question itself so that I have to explain a concept particularly to you guys. Okay. But if you see practically, your concept will hold good, your point will hold good, that this 2 lakh will increase to 2,40,000 or 50,000. Okay. Anyone else? Guys, I'm taking 15 minutes time I'm giving you. Then only I'll start the next standard. So if you have any queries within that time, definitely I can take it up. Okay. I'm stopping it here.